If I had to guess what next week is going to be like, I feel like we're going to get a lot more of what we just currently saw this week. A lot of chop, a lot of volatility, a lot of confusion. We do have the FOMC meeting coming into next week. It's going to be interesting to see how they respond to these rising yields. We got some very interesting charts to go over today. It's the weekly recap episode, so we're going to be looking at multiple different time frames here, the weekly, the daily, some other indicators that you may remember from previous episodes, some that might be new to you if you're newer here. We're going to be going over commodities, the dollars, bonds, yields, and the indices today. Just some interesting stuff overall. Like we're seeing this market go up, but you'll find it interesting to see what asset managers are doing during this time. A weird divergence taking place. Now, before we get into the show, today's episode is sponsored by Phoenix Gold Resources Corp. Yeah, that's right. They traded on the TSX Venture PXA and also in the OTC markets. We're going to be talking more about them at the end of the episode where I go more in depth about this specific company. I am not invested in this company at this particular point in time. I am being compensated to bring public awareness to the company. And by bringing them on as a sponsor today, I'm going to be removing all mid-roll ads from today's extended episode. It's going to be a little bit longer than usual because we got a lot to talk about. So let's just go ahead and get into today's episode. All right, everybody, welcome back. Hope you had an amazing week. We're looking at the market dashboard slide here. Then we're going to get into some relative rotation graphs. Starting here on this slide, I just want to call out, most of the indices did very well today. The VIX got crushed, typically does here on Fridays for some reason. Nasdaq down on the day, and I want to say something here. Tech, and I'll probably say it throughout the episode, but tech needs to start performing for this market to keep on pushing forward. It doesn't need to be a top performer by any means, but it can't keep falling and have the market rising at these rapid rates. You know, the S&P 500, and then we have the Dow Jones, the industrials. So we'll get more into that during the episode, but just wanted to call that out. As far as the sectors go, the spiders in the S&P 500, we got the 11 sectors here. Real estate and utilities took the lead. Interesting to see utilities up there. You know, utilities are more of a risk-off environment, but I do find this interesting because of what we'll talk about with asset managers here soon. From a relative performance standpoint on the daily perspective, look at energy coming. It's still leading the way, same with materials, industrials, but you can see financials actually crossed into weakening here. Now, this is looking at a 10-day, so 2-week trading day period on the daily time frame, and you can see utilities, that was a very big lagger over here, start to really show some signs of improvement. However, when you look at the weekly perspective, energy is still the top performer, financials, communication services too as well, and utilities is way down here and lagging, trying to make itself come up back up to that improving sector. So maybe from this perspective, it's showing where we may go, and right here, we haven't actually quite reached that level yet. So something to keep in mind as we're going into the rest of today's episode. We're going to start off with the indices, mainly around the Wilshire indecision type candle. I believe sometimes you can call this a spinning top. I think I never really memorized too many names, but you got to understand the psychology of this certain candle, okay? So first off, we broke out a strong breakout. We got back above the moving averages. We tapped into the previous all-time high, maybe pushed a little bit higher, didn't close there though. So, you know, this could be a potential double top. Breaking out of this type of pattern could set us up to go to 44,000 quite easily, but it might, be a little of an effort to get there. So we might see some ebbs and flows. Price percent oscillator is crossed above, bullish crossover. Now, what do I mean by spinning top or this type of candle? Well, we have a strong move to the upside, and we had big green candles, and now we're seeing some indecision. So we had force, bullish force, and then all of a sudden, bears kind of came into play a little bit, and then the bulls fought back. So now we're in this battle zone trying to reach to these all-time market highs. From a bullish perspective, we're still trending up with higher highs. We haven't put in a lower low really. This is relatively flat here, and we came down. This dash line is the year. We came down, bounced again from the year. That's the second time that has happened. So Overall, we're still in bullish context. We're above the 5 period, 10 period, and the 20 period, and it looks like they want to continue to cross over. But also keep in mind, while we go through this episode, I'll show you the VIX, show you some other charts. This could always be a potential double top too, and this candle right here could suggest that. So yes, more ideals right now are currently in the bulls' favor because of this breakout above the moving averages and the context of the chart. But there's a couple bearish things that we have to keep in mind at this particular point in time. S&P 500. Let's do that. Weekly time frame. Here we go. This chart should look familiar. I showed this on the previous weekly recap. Look, we pulled down 1, 2, 3, 4 times in the last total, around 12 months or so into the 20 period weekly moving average. And you can see we had an 8% drop, 10%, 9%. And this was only a 6% drop, but the amount of drama and emotion on this drop alone was significantly more, from my perspective, than it was over here in September when we had that 10% drawdown. So just interesting to look at that. This candlestick, pattern right here, these 3 candles, this happened on a pullback into the weekly moving average. This is a morning star reversal type pattern. So, I mean, it's not really on a pull down. It's at the top here, and we closed at a weekly high. If we get some follow through, that could really project us higher, 4,000 to 4,100. So we did pull back, touch into that weekly moving average. I will say the price percent oscillator is rather neutral at this particular point in time, and still technically is holding that bearish crossover. So something to keep in mind there. From a daily perspective, this trend line holding very strong, broke out of the pattern. As you can already see, we closed at an all-time high and still are in kind of a range where this could be considered a potential double top. The price percent oscillator did cross over. That's bullish. And you can just see these gray shaded boxes. These are all just a bunch of gaps forcing us higher and higher. And once I get into the VIX section and the stock market indicator section of this, I'll be a little bit more cautious with not with my words, but I'll tell you to be really why you should be a little bit more cautious while we're pressing higher at these specific levels. Now let's look at the Dow Jones on the weekly time frame. The Dow Jones Industrials are just flying sky high, 4% up for the week. That's pretty gnarly. So I'm just trying to find, where can this potentially go to? And this green trend line has been holding like a solid rock. Test once, twice, 3 times. Every time we bounce from those levels very significantly. So we're at an all-time high close. This is rather neutral, but still, bullish on the price percent oscillator. Moving into that oversold territory, overbought territory. We haven't been there for a long time, right? The last time we were there was actually December moving into 2020. Okay, so something to consider. The only resistance that I can see from a trend line perspective was this previous rising wedge here from 2019 to 2020, and it from a bottom, it acted as support. And if we just draw that out, see it crack down, and we really saw that big breakdown. Obviously, that was a pandemic, but you can still see the technical structure there. So this could set us up to even scream like a super melt up, blow off top to 34, 35,000 if we get some continuation pushing. But just note that right there, this candle on a log chart, by the way, you can't really tell, it looks linear, but it is a log chart. That is a big solid green candle, and think of it as a rubber band. A rubber band, you get stretched out, and then when you let it go, it snaps back. All right, so a lot of strength coming in here, but just note the bullish context from a large run-up. Like, for example, where can I point out? Yeah, this candle right here. So from March of 2020, we saw this huge run-up, okay? And this candle right here was a solid big green move, okay? Looks very familiar to this candle, right? And what happened? We gapped up and then just completely got obliterated, taking away that week's gains. And then we had some follow through to the upside. To be honest, April typically, from a seasonality perspective, I've been saying April you see some monster rallies, but in March you get this pretty solid peak in the middle of the month, and then you get a pretty sharp decline, and then that rally into April. So that's also kind of, a script that can play out. The transports, the Dow Jones transport, so you got, Dow theory, we're looking at the industrials and the transports, and we'll look at the util here too, utilities. So rising wedge pattern, just a huge move. So there's no divergence here taking place. Bullish crossover, just screaming higher after, falling down just past the yearly open, which is that dash horizontal line. So still in this pattern, this rising wedge pattern. It's not the structurally most sound thing, and you typically, when you get huge rips to the upside, you got to get some periods of consolidation. I will call out that the RSI from this chart is overbought, and we weren't even overbought in February of 2020 like we were in the industrials, so something to watch out there for. Now, the industrials on the daily time frame, you can see after it cracked through 32,000, it's just been screaming up. Price percent oscillator is nice and bullish. Perhaps maybe we get a back test and then a follow through, but right now it's just continuing to press and press and press. This chart right here might look familiar to some, but this is the DJA. So this is the Dow Jones Composite Average, and that is actually comprised of the industrials, the transports, and the utilities. Now, these typically move in lockstep, not like completely, because utilities are more risk-off trade. But as you can see, just from 2019, that they kind of trend up. This is kind of trending up. This one, transports, was relatively sideways, and then you have the utilities trending up here too as well. And then you had that really big move here in early 2020 with utilities showing some sort of caution, some risk off type stuff while it moved up higher, and these averages slightly moved up higher, not to this extent. But what I want to call out is the big divergence that's been taking place, not only since February, but also we can look from November. You can see from November on utilities from here to here, it is putting in that lower high. So you have this divergence that's lasting for multiple months now on utilities comparatively to the DJA. And if the Dow Jones Composite keeps on moving higher and higher and doesn't have the support from utilities, it did have a pretty solid couple of days, so it did bounce up here recently. But typically when you get these divergences build over a course of time, you need to be very cautious in those environments. And you can see here from November, clearly heading down, and then right from, from February, even November here, clearly up to all-time highs, to all-time highs, to all-time highs. Utilities hasn't even made an all-time high yet. So this is it's just interesting price action overall, and we should just be well aware of what's going on, beneath the curtain or behind the curtain, I should say, of the DJA, which is the Dow Jones Composite. Let's look at Nasdaq. What I said earlier in the show, what did I say? I said the Nasdaq really needs to start stepping up here, really because we need tech to play if the market wants to continue to push higher and higher. Now, from a weekly perspective, this chart, super bullish, but it's just a bullish chart overall, right? So we're looking at the Qs on the weekly time frame. It came down into the 20-week weekly EMA. It's done that once, twice. Now this was the third time. Where do we mark out? We marked out this as a target area, the 23.6 fib level. What do you know? We tapped into it. We bounced right from it, worked like a charm. Doesn't mean we're out of the woods, but we're back above the weekly 20-period moving average. So that is a good sign to start. However, on the daily time frame, when I say we're not out of the woods yet, we still have lower highs starting to build and lower lows in the short term. We're below the 50-period moving average. We're below the 20, and we had the 20-period moving average cross below the 50. This is how trends, they change. Okay, so you got to keep continuing to put in lower lows and lower highs, and that is what really sets the stage for a bear market to take place or just a trend to reverse. From high to low, obviously. From low to high, you need higher lows and higher highs. But right now, we're stair-stepping down. We got rejected from the 20 and the 50. We tried screaming up towards it. So this could very well just be a bounce to head lower. We're not confirmed yet. We still have a lot of time for this to play out. We'll see how next week presents itself with what the Fed is going to be doing. We'll talk more about that during the bond section and the dollar section. Price percent oscillator right here is also kind of curling itself up. It's below zero. That's bearish, and it's in bearish context. You have the black signal line below the blue right there. We need to see it cross above and get above zero to be more bullish. Then let's quickly look at the SOXX. This is semiconductors. Recently broke down from this rising wedge, had a negative divergence. We call that out. We broke down, came into the 20-period weekly EMA, has a little bit of a hammer candle here, bouncing from not only the 20 EMA, but also the 23.6 fib level. So perhaps we bounce up and retest these levels and then head lower, or this is just a period of consolidation before going up higher. So it's just something to consider, just going into the following weeks. I will call out the volume here too, which is kind of interesting. On the big down spike, typically on big points of, what's a good word here? Reversals or changes, you can sometimes see large spikes of volume take place. So, we came down here, you see this big volume accumulation spike. That was at that bottom right there, and then we started heading higher. This is now pulling down, and we're starting to see a lot more volume kind of flow in. It doesn't guarantee anything, but this could be very well a short-term bounce to potentially head higher, or we're just seeing the start of more selling come in. So there's a couple ways you can look at it there. From a price percent oscillator standpoint, bearish crossover, well above zero, but that so far is pretty bearish start. Now, the last time we really had a solid crossover like this was actually down over here in February, which obviously led to more selling. Let's look at the Russell now. Weekly time frame. Look at this thing, is just insane. Negative divergence still holding there. Huge solid week, up 7.29%. It's comical how vertical this is all going. Price percent oscillator jammed up there. Just kind of kissing the signal line there, so it looks like it's going to do a bearish crossover, but it won't do that if we get continued movements to the upside. Not a fan of these overextended levels. This could be just some interesting sort of buying activity coming in, and then we have the professionals selling their positions into the futures market, cash market, whatever the case may be. But very, very powerful move going into next week. From a daily perspective, still holding strong above this area that was previously resistance, now is support. Cracked an all-time high, bullish crossover. Perhaps we start to head higher here. It's anybody's guess at this point, but overall we're in bullish context. So it's not necessarily something that I would be trying to short at these specific levels. However, keep in mind, sometimes when you get, overnight, large gaps overnight, it creates a good potential to sell your position if you're long to take profits, or hedge short, because sometimes those large moves to the upside can reverse quite quickly and pull back into the levels of support or into the gaps and fill those gaps. Now let's look at the indicators. Got 5 or 6 to go through and some interesting things overall. Now, what I've been saying is while we're making these double tops, or as the market is trying to reach out to these all-time highs, which some are very successful doing, look at the VIX. The VIX cracked down through this green area of support that we mapped out and is starting to head lower to fill this gap right around 20. All right, what did I say previously about the VIX when it comes down into 20? It's probably a good idea to start looking at some of your positions to either take profits because of the fact that we usually bounce from that level. We haven't cracked below 20 successfully, for quite some time here. So now we're making another attempt to do so. Perhaps we keep on getting crushed down and the market continues to move higher. Maybe we even fill this gap that's been bugging me for over a year. But as I see it right now, we're within this channel still towards the lower end. And sometimes what I like to do is look at the VIX to really kind of determine, and by the way, before I say that, the VIX is still relatively high overall at this 20 level, while the market, you're seeing it just kind of, thrash around. So what I like to do is when we pull into these areas, I like to make sure that the position that I'm in various stocks, they're one, still quality setups, or two, if they're overextended by any means, I'd like to peel some profits off of it. So something to consider going into next week. As far as the CPC sell signal goes, we had that sell signal crossover. We did see a little bit of selling pressure. Are we out of the woods yet? Still too early to tell. We still have the CPC kind of heading lower. You can see the purple line in the background, and then this is starting to curl itself over. Once we cross back below it, that's that warning again, and then we have to be careful to watch for a cross back above that 0.8. From a breadth perspective, nothing really changed here. Still 36.24. Negative divergence still holds, not overextended to the upside yet. As far as the bulls and bears ratio, this is a sentiment. What's the sentiment of the market saying? Very bullish is what the sentiment of the market is saying right now. I will call out the ratio itself is above 2.0. That's a pretty overextended level, and typically you can look at this with the contrarian type view, where when everyone's super bullish, you might want to start pumping the brakes a little bit, because when you get to these overextended levels, especially on negative divergences as we've seen, you can see some pullbacks take place in the market. So nothing's one for certain in the markets, obviously, but it's just something to take note here. Now, what I've been saying about asset managers that's pretty interesting is we had a pretty solid green week, and when this kind of histogram is up, above 100, that's when like you're max long, where asset managers are max long, and if it's above 100, they're even using leverage. But look where we are right now on this current reading. Now, it's March 12th, the week closed. We're just above 40. It's at 48.62. That's just kind of interesting to me to see this big spike up here. We're relatively low here, which is actually lower than the September pullback by a few points there. And then the right X2 is still relatively bullish. And, that hasn't really changed too much. But just note that I just find this really interesting. I wonder what's going on. So asset managers here are just spiking down, but we're seeing the cash market obviously move up here. So just something interesting to take place, because we're talking about professionals here, okay? So take note of what the professionals are doing. I like looking at this at overextensions and things like that, but I just find it kind of interesting here that, the foot's coming off the gas a little bit. Now, from a rate of change perspective, when we look at XLU to over SPY, we had a pretty big spike up on the 4-week rate of change, not quite above zero. This is part of Michael Guyad's beta rotation strategy, which is a white paper, award-winning white paper. It's still not above zero, so this is still risk on, but it does look like if we get catch another bid in utilities, this can flip risk off fairly quickly. And then from a lumber to gold perspective, we're still risk on, but just notice from February, we've been sinking lower and lower. If we cross below zero, that is that risk off environment. It's been known to predict quite a few crashes that have been taking place in the markets and pullbacks. It doesn't mean that it's predicting a crash. I shouldn't say that, but it tells us that the conditions for an accident to occur are greater than usual. And then the last thing I want to look at is the percent of stocks above the 200-day moving average. We were jammed up at some high levels. Then we kind of took a little bit of a breath for, we don't typically hold these jam levels for too long. You get spikes and it comes down. But I will call out, we do have a negative divergence for what that is worth, but we have it. You can see it right here. We're running 86.37% of stocks are above the 200-period moving average. We have a lower high there as the market put in fresh all-time highs. So just interesting stuff going into next week, to say the least. And that's why I started this episode kind of like, I don't know, next week could be a little volatile. Gold, let's looking at commodities now. Gold found a little bid right here at this this pink box. That was right around that support level around 1700. Look at today, we saw a pretty weak day, which I find interesting because yields, the 10-year yield started off the day and finished the day very, very strong. But gold actually ended up catching a bid. So this was interesting to me because it was a pretty solid down day, and then we bounced right from 1700. This, to me, is not a bad sign for gold. Maybe this is putting in a short-term bottom and we try to head a little bit higher here. Nothing's for sure yet. Definitely not out of the woods. We still have lower highs and lower lows. Silver also as well showed a lot of weakness today. It was a big solid red bar. We haven't recaptured the 50-period moving average. We haven't fell below the 61.8 with a solid close below there. This support line was broken and we back tested it, so this can be the start of a move lower. We have to recapture the 50-period moving average in this green line of support. That would give me more confidence that silver can head higher, but as I see it right now, it is not in the greatest spot. Crude oil, relatively flat for the day, just holding above that 64 level of support. It was resistance, now it's support. We said if it cracked below that, we can easily go reach 60. Still haven't cracked below it. So right now we're in this little period of consolidation, overall bullish context. The CRB on the weekly time frame, holy moly, this thing has just been jamming up from the April bottom here. You can just see that it broke out of a 2-year downtrend line right here. We're screaming up higher, didn't even back test. And the next area of resistance that I want to call out is right around 200 to 210, that kind of zone right in here. You can see it acted as support, bounced above, then finally cracked below, retested, and then headed lower. Now let's take a look at Bitcoin. Bitcoin's struggling to get above 57.5. I feel like if we crack that, this could be a little cup, a very short-term cup and potential handle, crack above that 57.5. So keep an eye out for that. This red line, that is actually an area of support now. It was resistance, now support because it well, because once resistance is broken, it then becomes support. That's right around 52,500. I do think that if we start cracking above 57,500, we're going to have more momentum to the upside. That would make sense to me from a technical perspective and overall bullish context, right? We're 50 period sloping up, 200 sloping up, MACD is nice and crossed over right there. We're putting in higher highs, putting in higher lows. Everything looks good. Now let's look at the dollar. The dollar came back to try to go test that 92 level, got rejected. This is what I find interesting is the move in the dollar today. We saw the weakness in gold and in silver. Then the dollar got rejected and we started to see gold catch a bid and silver. So, it's like silver's really kind of following the dollar and the gold has been following the 10-year. So there's just all these interesting correlations going on in the market right now. Also to note, if the dollar continues to fall like it did here when we ran into this resistance and then headed lower, that really fueled the S&P 500, as you can see down here. And that also fueled the CRB index. It fueled oil. It fueled various other commodities. What it didn't fuel was really gold. And the reason why it didn't fuel gold's move was because gold is trading like a currency and it's just pegged to that 10-year yield, it seems like. As that rises, gold continues to fall. So we're coming into areas of resistance in the yield, and we're bouncing from an area of support on gold. And so this, to me, is a very unique position where perhaps gold is putting in that short-term bottom, potentially a long-term bottom. I don't know yet. But regardless or not, gold does present a really good opportunity here as it's been beaten down. Maybe not for a large leverage position or anything like that, but I personally have been adding to my core positions. Now, the dollar is not fully out of the woods here either as far as heading lower. This is a heavily shorted position. But keep in mind, just because it didn't make it above 92 and hold there this time, it doesn't mean that it's not done trying. So we got to keep an eye out to see if we can crack above 92 and hold it. The 200 period, that Godfather moving average, is sloping further down now, and you could see as price holds below that, it's going to continue to move lower. You see these moving averages start to turn up a little bit and start to head higher. So perhaps this is just a longer term bottoming process right here. We don't know yet, but I'm sure that we'll probably see some large dollar movements here when the FOMC comes and when the Federal Reserve Chairman speaks. From a weekly perspective, this right here was a solid breakout of a falling wedge. Perhaps this is where that 92 resistance is. We tried getting above. We couldn't hold it. Perhaps we move down a little bit, retest, and then crack above, or we consolidate sideways, then crack above, or that was it. This was a complete fake out. It's hard to say at this particular point in time, but the underlying market here, the RSI, that was that bullish divergence. We had the price percent oscillator it does look pretty bullish right here too, but it's still below zero. So, this is just interesting stuff. We saw this happen in 2017 to 2018. We cracked above it. We didn't actually really have too much, resistance. We just started moving higher and higher as the weeks progressed. So, I think that 92 level is a key level right here, and we need to have a weekly close, a couple daily closes above it to give us some more confidence that, the shorts might begin to really kind of unwind or cover their positions, and that could really push the dollar a lot higher, sending gold lower. It could send silver lower, but as it stands right now, the dollar is holding at that area of resistance. So, interesting things overall. Bonds and yields, 10-year. Just look at this thing go up 5.13% for the week. Heading, this is just insanity moving right here. So, and we'll show you the spreads here in a moment. And this is one of the reasons why this correlation from the 10-year and these tech companies are getting hammered to the downside. It's hard for them to catch a bid. So if this continues running this 1.9 to 2.0 range, that would be that next area of resistance. You saw it pull here, bounce, break down, resistance again, and then fell through. So, that's the next level, key level I'm looking at here. Perhaps we slow down. There's always the thought of yield curve control or Operation Twist or some form or some different name of that where we just, the Fed steps in and doesn't allow these rates to keep continuing to rise here. Overall, they're very overbought. As you can see here, very, very overextended RSI. So perhaps what could be a great play is if we start seeing this turn down, they start heading lower or, taking a breath, you can see gold continue to catch a bid as long as that dollar keeps continuing to fall. And that might also push the tech sector back up out of its current trend. Now, as far as the yields go, this is the 10-year, the 30-year, the curve right here, the 10s and 2s, completely steepening, printing at 1.5, so highest in quite some time. The 10-year just flying up higher, the 30-year flying up higher. When is this going to be an issue? It's very hard to say, but I can't wait to hear what the Fed has to say tomorrow about all of this stuff. It didn't seem like the Jerome Powell, it just didn't seem like it was a care in the world that rates were continuing to rise. So perhaps it's going to be a different tune now that the market said, oh, if this doesn't, scare you, let's continue to push them higher. And that's what we're seeing. We're seeing the 10-year at 1.64 now, the 30-year at 2.4. When is he going to take notice? When is this going to, when is the Fed going to step in? When are when are the market participants going to, have, their Uncle Powell step in and let them know that he's here to protect the markets? Because as I see it right now, these yields scream higher, the dollar's kind of fluctuating back and forth, and we're seeing individual stocks, we're seeing tech breakdown, and we're seeing just a lot of volatility overall in the market. So this looks like a stage 3 distribution. It looks like the market could roll over at any minute, but the market continues to press higher and higher in certain indices and certain stocks. So you got to be very careful next week and the following weeks per usual, because it is some crazy stuff. With that said, that was pretty much my conclusion talk track right there. I wanted you to just take note of what the dollar did today, getting rejected at 92, the utilities, that divergence taking place, and utilities being one of the top performers for the day on Friday, especially on a VIX crush day. So also very interesting stuff when we talked about the relative rotation, how energy has been performing very strong from a weekly perspective. But when you look at the daily, it looks like utilities is trying to move into that improving, like it's trying to start stepping up here, which could suggest that we're seeing that risk-off environment more sooner than later as the market continues to make these all-time highs. So be careful out in the markets. Alrighty, it's time to get into today's sponsor. Let's learn more about Phoenix Gold Resources Corp. Once again, just to note, I am being compensated to bring public awareness to this company. I do not have any invested money of my own in this company at this particular point in time. This is Phoenix Gold Resources Corp. They are traded on the TSX Venture under ticker symbol PXA, and they also trade on the US market under the OTC markets. Now, they are a mineral exploration and development company that acquires and explores for gold properties in the United States. It's a small market cap company. It's kind of under the radar. Their market cap as of late February was only $9.2 million. Now, when it comes to investing in or trading smaller cap companies or speculating in these smaller cap mining companies or exploration companies, it's always important to look for a quality team. And you can see here, this is Sean, the CFO. He is a CPA, and he is among one of the best in the business, having served as a CFO for Ecuador Gold, Copper Corp, Northern Sun Mining Corp, and others. Roger Bear is the director, and he has 30 years of financial management experience. He's kind of known as the mining market maven, and he's worked with companies like Newmont Mining, Rio Tinto, Thompson Creek Metals, Cypress Amax Mining Corporation, and others. Another notable director here is Walter Davidson. He has been a director for several mining companies in addition to serving as a member of the Legislative Assembly of British Columbia, Canada for 16 years. He was even awarded the Queen Jubilee Medal for outstanding service in Canada. And then we have the CEO and director, Andrew Lee. He's been involved in the junior mining industry for the past 15 years and has served on the board of several companies, both listed on the TSX Venture and the CSE, and held an executive role as VP of Megastar Development Corp. So we've went over that they're a small market cap company. They have established leadership. Now we're going to get into their projects that they're currently working on. And just to note that not only a small market cap company and having established leadership, but high grade mineralization and historically proven geographies, those are the keys to the kingdom in the resource sector. The first property is in Newfoundland, the York Harbor property. This comprises of 5 licenses and 156 claims totaling 39 square kilometers. The exploration activity at this mine goes way back, approximately 90,000 tons of ore grading. That's 3 to 12% copper and 7% zinc extracted from 1898 to 1913. Here you can see the historical production, the mine right here, and then you could see the map overview on this slide. This slide can be found on their website, which the link is in the description, and you could download their corporate presentation deck. Extensive exploration by various companies with drilling totaling 90,000 meters has already been conducted on the York Harbor property. 11 zones of copper, zinc enriched massive sulfides are confirmed on this property, which is highly prospective for exploration upside. Many of the intervening areas between the zones are untested and appear to be open in one or more directions. Past exploration activity indicates that there is exceptional prospectivity at the York Harbor site. Now, what I find very interesting is the Nevada project. This is one of the top global mining jurisdiction. Phoenix Gold explores in the Battle Mountain Mining District, which is among the largest gold producing regions in Nevada. You can see here slightly this green box here and this green box here, both Plumas and Eldorado properties. Those are their projects that we'll be getting into. The district has been targeted for exploration by Nevada Gold Mines, LLC, a joint venture between Barrick and Newmont, 2 of the largest gold producers in the world. The Phoenix Gold Project is strategically located next to Nevada Gold Mines, LLC, Fortitude Gold copper mine, and it lies within the company's approved environmental impact statement, the EIS, and permitted plan of operations. So let's look at the 2 properties within this jurisdiction. We are looking at Eldorado first. 50% owned by Phoenix Gold, and 50% of this is owned by Newmont Mining. 1 patented claim, 20 acres. It's 1,500 feet by 600 feet, located adjacent to Sunshine Pit. 2 RC drill holes were made by Newmont in 2013, outcropping high-grade gold system targeted with gold oxide sulfides. This is the Plumas property, and some key highlights here is it's 50% owned by Phoenix Gold, 50% owned by Bill Matlack. They have 2 patented claims, 3,000 feet by 600 feet, 1 mill site claim, and extralateral rights. Phoenix Gold drilled 7 holes in 2014, totaling 4,400 feet, outcropping high-grade gold system targeted with gold oxide/sulfides. Extralateral rights allow Phoenix Gold to both explore and mine down dip, even onto Newmont land. The northern section of the claim has never been drilled. Now, Phoenix Gold is sharing the broader Battle Mountain Mining District with some of the most renowned miners in the business, all of whom clearly see the vast prospective possibilities in this Nevada region. Now, Phoenix Gold's strategy is drilling to discover a potential resource of gold, silver, and copper. Established miners like Newmont and Nevada Gold Mines have a notable presence in the region. Gold Independence Mining is aggressively drilling to prove a current resource, and others like Gold Standard and McEwen Mining are progressing towards production. So what could potentially shoot the share price higher? Well, it could be something as a mineral discovery, or perhaps even a joint venture sale or spin out could potentially move this stock higher. But just know that there are risks when it comes to investing and speculating in not only exploration companies, but any stock that you decide to put your hard money into. If you want to learn more about Phoenix Gold Corp, I'm going to have the links to their website and their tickers in the description section below. And I will see you back on the next Daily Stock Market Brief.